So we continue. So now the matter at hand is to the company earns a consistently higher rate of return on shareholders' equity, or as it called ROE instead of ROI. So the return on the shareholders' equity. We begin by an example. Okay, let's say you buy a house for the purpose of renting it. You want to rent the house. Okay, and let's say you pay 300,000, not a big house. You pay cash and you give $50,000 cash, and that gives you a mortgage of 250,000. The gross rent is 1,500 a month, so 18,000 a year. You have expenses, tax, insurance, interest, and stuff. There is a net at the end of the year of $5,000. So what will be your ROE? What will be your return on equity? Usually in class, I will wait, but it is a pretty easy answer. You should be able to figure it out. So your equity in that particular investment will be your cash. You put $50,000 down. The bank has fronted $250,000 for you, but you just had paid $50,000, and the rest is paid by itself by the investment, by the rent. And the 5,000, you divide the 5,000 by the 50,000, so your rate will be 10%. So that will be a good investment. You will make 10% on your money based on those numbers. If you would like to have higher numbers, you can say, I will buy two houses instead of one with my same cash. And instead of putting just so for each house, if you analyze it differently, you put a cash of just 25,000 on the house instead of 50,000, same $300,000 house. Because the interest rate will be higher, let's say that your net income will be 4,000 instead of 5,000. So what will be your ROE now? Your ROE will be better because you will make less. Instead of 5, you will make 4,000, but you just have $25,000 of cash. So 4,000 on 25,000, that gives you a yield of 16%. So when you there is a sense to borrow money to make money. Friend of mine, great credit, great job, great things, great everything, and he bought a triplex, and with no cash. The bank they make him sign, and the deal was $400,000 or $500,000. They know his name, they know everything he has in the back, and he was able to make an investment with no cash down. So that's an infinite return on no cash. He had the equity to back it up, but it is with no cash that he'd make the deal. So when the bank put all the money and you have good interest rate, it can make sense to leverage sometime, not all the time, but the good CEO do that for their companies. And again, we will look at the different company that we are analyzing since the beginning, and we'll see a flow of their ROE over time. So we begin again with the bank, the CIBC Bank, and I have the numbers until 2011. So in 2011, you have 16% of ROE. And when I was working at the CIBC and the Royal Bank, that was their main challenge, their main focus. They were focused on that particular numbers for the bank, for the banking industry. It is a very, very important metric, and they always follow it, and they all try always to push it up. The bar of the 20%, it is always in their mirror, in their aim. Very difficult to break the 20%. It happens from time to time, but very difficult to be at that level. But still, CIBC 16, 17, 19 in 2014, 27, but that's just for a year in 2015. And then now it's back to 19.8. That is very, very high. The Royal Bank, 18, 19.7. Like I told you, it's very difficult to have the 20%, to hit the 20%. 19, 18, 18, and 16. So these are good numbers, very good numbers. That is the amount of net income that they generate divided by the base of shareholders' equity, and it is a compounded. It is time after year after year after year. So it has a compounded effect on the shareholders' equity, and usually there is a correlation between that and the stock price on the stock market. Alphabet now has 16, 15, 14, 15, 15, so a little less high, but they have a big base of capital, but still good numbers. When it is above 12%, 15%, these are good numbers. Apple, they are unusual. They have the moat. They have the ability to produce mass market products by the million, by the gazillion, naming the iPhone. But they have the ability to price it up at a price that people are willing to pay, and that gives them tremendous margin. So as a company, look at the numbers: 33, 35, 30, 33, 24, and 36%. That's unheard of on that long term. Ford, they need a bigger base of capital. They have good numbers because in 2009 they were a little bit like Bombardier. Their shareholders' equity was it was minus, so they were technically like bankrupt. So they have a small number of shareholders' equity, so the percentage are higher at, the 134% in 2011 just goes to show you that there's a very small number of shareholders' equity. They were going out of the recession, but now we are going to more normal numbers like 15.9 in 2016. Toyota is more normal it's a good company, but it's a car company. It will never be the same margins as the banks or as the companies in the technology industry. Costco, good, well managed company, 12, 13, 18, 17, 21, 20. So they are above the 20 mark for the last 2 years. Goes very well. The only thing is, how will the battle with Amazon go? Amazon, it's not the Amazon. When you look at the core number of earnings and stuff like that, it's not there yet. As you can see, Bombardier, I have talked about enough, and Couche-Tard. Couche-Tard has a tremendous good balance of leveraging with what they go, and the liabilities and the debt they take is well taken. They make good acquisition, and the shareholders' equity returns are very good, and the stock market is giving it back to them in their valuation. We have 23, 27, 26%. That is a very, very, very good.